My dear friends, welcome back. Today I want to begin with a story, one that I have rarely shared, but one that holds the very essence of psychological discipline in investing. If you understand what happened in this story, you will understand how to remain calm when everyone else is panicking. And if you master this lesson, you'll carry an anti-panic investing framework that will protect you not only today, but well into the future. Let me take you back to a moment from my own career, sometime in the mid-20th century. I remember walking into my study early one winter morning. The newspapers were filled with gloomy headlines, the kind that grab the emotional mind before the rational one wakes up. Investors were terrified, markets were trembling, and fear was spreading faster than facts. It was during this period that I received a letter about a company called Central Iron and Tools Corporation, a solid mid-sized manufacturing firm whose stock price had collapsed in a matter of weeks. Now, what made this situation so interesting, what made it so educational, was not the company itself. It was the behavioral reaction surrounding it. You see, my friends, when panic hits, something predictable happens. People stop thinking in terms of intrinsic value and begin thinking in terms of emotionally charged stories. They abandon analysis and surrender to imagination. They drown in fear and forget the quiet clarity of numbers. But the numbers, as always, were calm. Before analyzing Central Iron and Tools, I paused for a moment and watched my own mind. I always teach that the investor's first responsibility is not to study a company, but to study his own state of mind. Was I reacting to the noise? Was I reading headlines or reading reality? This, right here, is the first hidden key of intelligent investing: awareness of your psychological temperature. If you can measure your emotions before you measure a balance sheet, you will be far ahead of the average investor. The letter I received claimed that Central Iron and Tools was on the verge of collapse, that its orders had shrunk, its industry was weakening, and its future was uncertain. The market had dropped the stock from $40 to nearly $22. That is a brutal decline for any company, and naturally, investors panicked. But panic is not analysis. It is a behavioral trap. So, I opened their financial statements. This is where the second hidden key appears. Facts are quiet, emotions are loud. The company's current assets were still strong. Their liabilities were manageable. Their inventories had not deteriorated. Even their normalized earnings, a concept many of you know well by now, remained intact despite the temporary slowdown in orders. At that moment, I knew something most investors never discover. The price collapse was emotional, not fundamental. Let me explain why this matters for you today and for many years ahead. Modern markets move faster, information spreads quicker, and fear can scale globally in minutes. But human psychology, that barely changes at all. What frightened investors in my day frightens investors in your day. Mr. Market still has mood swings. Margin of safety is still your shield. And the danger of acting under emotional pressure is still the greatest threat to long-term wealth. As I looked deeper into Central Iron and Tools, I realized that the crowd was running from a shadow, not a fact. They were responding to temporary headlines, not long-term value. And that brings us to the third hidden key. True investors think in years, not weeks. Whenever you find yourself overwhelmed, remind yourself that your timeline is your greatest advantage over the crowd. In a moment, I will walk you through exactly how I analyzed this company and how I arrived at a rational, unshakable conclusion. But before we move on, I want you to internalize this opening lesson. Panic distorts perception, but disciplined thinking restores truth. Now, my friends, let's roll up our sleeves and enter the heart of the analysis. Now, my friends, let's continue our journey into the heart of this analysis. Let me show you exactly how I approached Central Iron and Tools during that moment of widespread fear. This part of the story is crucial because it demonstrates the rational process that intelligent investors must follow, no matter what era they live in. I began, as I always do, with the balance sheet, the quiet foundation beneath all the emotional noise. The company's current assets, its cash, receivables, and inventory, were nearly unchanged from the previous year. Their liabilities had not exploded. Their working capital was healthy. In fact, when I calculated their net current asset value, the number surprised even me. It was strong enough that, in a liquidation scenario, shareholders would have likely received more than the entire market price implied. This, my friends, is the first analytical anchor. When the balance sheet is strong, temporary fear cannot destroy true value. But of course I needed to go deeper. Panic often distorts future expectations, so I shifted my attention to the company's earnings power. Most investors were obsessing over the most recent quarter, which had weakened due to a temporary decline in orders. But emotional minds confuse temporary events with permanent truths, so I took a broader view. I looked at the past 5 years of earnings, smoothing out the unusually strong and unusually weak periods. This produced what I call normalized earnings, a far more accurate reflection of a company's real earning potential. When I ran the numbers, normalized earnings were still intact. The company's earning power value, a concept many of you now use in modern analysis, remained stable. The temporary slowdown had affected perception, not reality. This leads us to the next hidden key. Never allow short-term volatility to rewrite a long-term story. Now consider what was happening in the market at this time. Investors were trapped in what I call the behavioral spiral, a cycle where fear fuels lower prices fuel more fear, and rationality disappears entirely. They were not responding to data, they were reacting to each other. They had fallen into the psychological trap you hear so often in your own era. If everyone is selling, something must be terribly wrong. But that is not analysis. That is herd behavior. As I continued my review, I noticed another fascinating detail. Central Iron and Tools had maintained steady investments in equipment and facilities even during the downturn. This indicated that management believed in the long-term durability of the business. Whenever a company strengthens itself while investors weaken emotionally, that is often a powerful signal, one that the crowd rarely sees. Let me pause here and connect this to your world. In modern markets, investors are bombarded with information, charts, forecasts, commentary, alerts. But more information does not create more wisdom. In fact, without emotional discipline, more information simply amplifies panic. This is why you must adopt what I call an inner margin of safety, a psychological buffer that protects you from reacting impulsively. Let me give you an example of how this works. Imagine you check a stock price 5 times a day. Each fluctuation feels like confirmation of disaster or triumph. But if you check it once a week or even once a month, suddenly the noise disappears and the truth emerges. The business is either stable or it is not. You no longer allow Mr. Market's mood swings to rewrite your understanding. Back to Central Iron and Tools. When I combined the strong balance sheet, the stable earning power, and the clear evidence that the downturn was temporary, the conclusion became obvious. The market was wrong, and the panic was exaggerated. But here is the deeper lesson, and I want you to remember this for the rest of your investing life. Panic creates mispricing not because businesses change, but because minds change. We had reached the point in the analysis where most investors give up, overwhelmed by emotion. But this is exactly where the intelligent investor gains their advantage. This is the turning point, the moment where rationality looks expensive and fear looks safe, but the truth is the exact opposite. In the next part, I will show you how I estimated the company's true intrinsic value, how I applied my margin of safety, and why the most important decision I made had nothing to do with prediction and everything to do with discipline. Let's continue. Now, my dear friends, let's continue our analysis and step into the part most investors misunderstand, the estimation of intrinsic value. Many think intrinsic value is about making grand predictions or constructing complex mathematical models. That is the language of speculation, not investing. Intrinsic value, as I've always taught, begins with earning power, not imagination. So I asked myself a simple and timeless question. If Central Iron and Tools operates normally, what will it earn on average? Not in a perfect year, not in a disastrous year, but in a normal year. The state where businesses naturally settle when panic fades and reality returns. When I applied this approach, smoothing out the emotional extremes, the company's earning power value became clear. It was not a high-growth business, nor did it need to be. It was steady, predictable, and supported by decades of operational knowledge. This formed the second analytical pillar. Earning power is the heartbeat of intrinsic value. Next, I applied a conservative multiplier, what you modern investors would call a multiple, or a discount rate. And here, my friends, we arrive at the hidden truth that few investors ever grasp. Choosing a multiplier is not just about mathematics, it is about temperament. The more uncertainty you feel, the higher the discount you demand. This is how you build the famous margin of safety, not as a formula, but as a psychological defense against your own tendency to overestimate the future. When I completed the calculation, the intrinsic value of Central Iron and Tools turned out to be significantly higher than the price the panicked market was offering. Rationally, the stock was inexpensive. Emotionally, it was terrifying. This is where the true divide between investors and speculators reveals itself. Let me pause to give you an insight that guided me throughout my entire career. When fear is high, value hides in plain sight. Most people cannot see it because their minds are busy imagining catastrophe. But value does not evaporate when emotions rise. It simply becomes temporarily invisible to those who stop looking. Now let me bring this lesson directly into your world. Modern investors face a challenge that my generation never did: constant stimulation. You are surrounded by price alerts, notifications, charts, forecasts, and emotional commentary. These forces hijack the mind. They activate what behavioral theorists today call loss aversion, recency bias, and confirmation bias. But long before these words existed, I had already learned the core truth. The battle is never with the market. The battle is always within the investor. This is why I developed what I now call the anti-panic framework, a mental model designed to protect rationality during moments of distress. Let me share the first part with you. 1. The anchor of facts returned to the balance sheet. Return to normalized earnings. Return to the quiet numbers. Facts are the antidote to emotional exaggeration. 2. The anchor of time. Extend your horizon. Think in years, not days. Time dilutes noise but amplifies truth. This alone gives you an overwhelming advantage. 3. The anchor of pre-commitment. Decide how you will behave before fear shows up. If you wait until panic begins, it is already too late. This is why I often repeated, discipline is built before the storm, not during it. Back in my study that winter, these anchors guided every step of my analysis. While the market screamed disaster, I simply followed the checklist. The company was stable, the value was intact, the discount was generous, the panic was irrational, the decision became obvious. But here is the part most investors never understand, and I want you to hear this as clearly as possible. A correct investment decision does not always feel comfortable. In fact, the best decisions often feel deeply uncomfortable because they require you to stand still while the crowd runs. In a moment, I will tell you what happened after my analysis, how the story unfolded, and what it revealed about investor psychology. But for now, internalize this truth. Intrinsic value isn't just a number. It is a psychological anchor that keeps you steady while others drift. Let's move forward. My dear friends, now let me tell you what happened next, because this final part of the story reveals one of the most important truths in all of investing. After completing my analysis of Central Iron and Tools, I reached a quiet, rational conclusion. The market had overreacted. The company's intrinsic value was not destroyed, only the crowd's confidence was. So I held my ground. I refused to let fear dictate my decisions. I trusted the anchors, facts, time, and pre-commitment. But the rest of the market, they continued spiraling. For weeks, the stock drifted sideways, weighed down not by fundamentals but by memory of fear. This is a powerful phenomenon, one you will see throughout your investing life. After a sharp decline, investors often remain frozen, waiting for certainty before returning, but certainty never arrives. Only hindsight does. And then, something completely predictable happened. Orders at Central Iron and Tools began to normalize. Inventories stabilized. Clients resumed purchasing. Management released a quiet update, noting that conditions were improving. Nothing dramatic, just the natural rhythm of business returning to equilibrium. Slowly, quietly, the company's reality surfaced again. And as it did, Mr. Market, who had been depressed and fearful, lifted his mood. The stock rose from $22 to $28, then $31, then $34. Investors who had panicked at the bottom called it a mystery recovery, but there was no mystery. Value had been there all along. Panic had merely hidden it for a while. Let me be absolutely honest with you. Most people do not lose money because they buy poor businesses. They lose money because they cannot hold good businesses through temporary fear. This is the central behavioral error I witnessed throughout my career, and it remains the dominant error today. Now let's connect this to your era. In modern markets, price moves faster, news spreads instantly, and emotions scale globally within minutes. This means you must be even more deliberate in cultivating what I call psychological liquidity, the mental space to think clearly during chaos. Without it, you will drown in the noise. With it, you will see opportunities invisible to others. So let me give you the final principles of the anti-panic framework, the ones that will carry you into the future. 4. The 48-hour rule. Never act on fear the moment you feel it. Wait 48 hours. Revisit the facts. Let your mind cool. Rationality cannot operate under emotional heat. 5. The emotional circuit breaker. When headlines intensify panic, do the opposite of the crowd. Slow down. Reduce stimuli, turn off price alerts, limit exposure to noise. You cannot outsmart fear if you continuously inhale it. 6. The long-term identity. Decide that you are not a speculator, but an investor. Identity shapes behavior more than intention. When you declare, "I am a long-term investor," your decisions begin to align with that truth. Back in my study, I did not know exactly when the recovery would occur, but I knew the company was sound, I knew the price was irrational, and I knew that discipline, quiet, steady discipline, would carry me through. And so, my friends, the final lesson is this: panic is temporary, value is persistent. Your discipline decides which one controls your destiny. As we close today's conversation, I want you to remember something I learned over decades of market observation. You do not need extraordinary intelligence to succeed in investing. You need extraordinary temperament. If you can master your internal reactions, your fear, your impulses, your urge to follow the crowd, you will already be ahead of 90% of market participants. The principles I shared today protected me in my time, and they will protect you in the years ahead. Whether it's today, 5 years from now, or deep into the future, the world will continue to change, but human psychology will not. And this gives you a timeless advantage, an edge you can carry for the rest of your investing life. Thank you for spending this time with me. In our next conversation, we will continue building your foundation of intelligent, behaviorally aware investing. Until then, hold steady, think clearly, and always insist on your margin of safety.